This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Bond traders pull forward expectations for the first Fed cut to November, ahead of a key US jobs report out later. Apple jumps in late trading on upbeat growth forecasts and a record-setting buyback. Hamas says it is studying a temporary ceasefire plan with Israel in a positive spirit and plans to send a delegation to Egypt as soon as possible. And we have a special episode of Africa Amplified, looking ahead to this month's pivotal election in South Africa that's coming up in just 30 minutes. But it's gone 8 a.m. across the Emirates. I'm Vonnie Quinn in Dubai, and let's take a look at how we are shaping up for the Friday session. We already had a bit of a relief rally on the go, and then we had Apple beating, and that definitely will help momentum today because shares there popped about 7.5% in late trading yesterday at one point. So as you can see, we were pointed higher for S&P and Nasdaq 100 futures. This, of course, a bit of a relief rally after the FOMC and after data. We are looking ahead, though, to that all-important jobs report. 240,000 is the Bloomberg consensus estimate right now, with the unemployment rate staying at 3.8%. Take a look at this, though. The two-year yield, we're all the way down now to 487.27. We have a very special guest in a moment who's going to tell us exactly what's going to happen next, so stay tuned. And then Brent crude putting on about 28 cents there, but we're at 83.95. All of that geopolitical risk premium seems to have come out. That on top of extra storage data showing lots more barrels out there. Take a look at this chart because it illustrates just how traders have repriced once again since Tuesday. I mean, that two-year yield says it all, right? We went from 504 all the way down to 487. Well, right now, we're pricing in one cut plus a basis point by November, and we're very close to the Fed's two cuts by December. Traders pricing in about 40 basis points of cuts this year. Let's check in now on how markets in Asia are faring. Some of them closed, many of them open. Avril Hong is in our Singapore studio. Avril.
Yeah, Vonnie, we're seeing a recovery in the Asia-Pacific as well. The mood is upbeat, especially after a Fed that was less hawkish than feared. Apple results not as bad as expected. So we're seeing the stock benchmarks rising in the Hong Kong benchmark. It is the Chinese tech names that are underpinning the surge. But you see an outlier, Nikkei futures in Singapore pointing to declines when markets in Japan return from the long weekend. And that is something to do, I think, with what we're seeing on the recovery in the Japanese yen. Flip the board. We've seen it on quite a ride this week. It has recovered towards that 153 level, and this is helped along by some of the intervention that's been suspected, but also the dollar slump. The more recent moves in the past 24 hours are seen to be an extension of the trimming of those huge short positions, as you can see from this chart, and what we were coming into this week. For now, we're seeing the yen pairing some of the gains from earlier on, hovering at the 153 level as the focus shifts to the US jobs report, Vonnie.
Avril, thank you so much. Avril Hong there in Singapore. Treasuries then extending their post-FOMC rally ahead of the US jobs data due today. Bond traders have now pulled forward expectations for the Fed's first rate cut by a month to November. Let's bring in the all-seeing, all-knowing Stephen Major, HSBC Global Head of Fixed Income Research. So, Stephen, we've had the best two-day rally since at least January, right? Is there room for more?
Oh, there's plenty more. You're too kind, by the way. It looks like a triple top on the chart. Not that we hold much by charts. A client told me, actually, there was a previous peak, so that makes it four tops. Maybe we should call it the four tops. So the market seems to want to hold around the 5% level for the twos in the treasuries, and 10's a bit lower. So, and there's something quite strong and fundamental underneath this. The Fed doesn't want to hike, and they've just confirmed that. So it's very, very unlikely rates are going to go up. And if you know the next move is down, you have an asymmetric setup. You might as well just be long and wait. Just be patient. They're going to cut. The question is it July or is it later in the year? And once they start cutting, they'll keep going, and bonds are going to do well. So that's part of the setup here.
So if you missed the last couple of peaks, or three, perhaps, if there was that third, you still have another chance.
Can you imagine the amount of regret bias there must be? Those who missed the peak in October and the previous one, and there was one before at the SVB situation. So I think many investors know that they should probably have some bonds because you just need them to balance a portfolio to start with. And 5 seems to be a magic number. It's not a coincidence that 5 is holding. 5 is sufficient to cover the inflation risk and give you a decent real yield.
Have you any concern about stagflation after the latest round of data?
Well, you heard what he said. I don't see any stag and I don't see that much inflation. So, and actually, I think the technical definition requires there to be a recession and inflation going up. And we're nowhere near that. So if there are varieties of stagflation light that might be possible, but it doesn't look anything like the stagflation of the 1970s. That's always been the fear, that you had some kind of wage price spiral with no growth. And that just really isn't happening, Bonnie. It looks very unlikely.
We will get more wage data, though. That'll be closely watched later today. What would cause this market to reprice once again, Stephen? It seems like every couple of days it's repricing now.
Well, I think we're due a period of calm. So I think bond investors are going to be happy if it gets a bit more boring, because it's supposed to be boring. It's not supposed to be drugs and rock and roll. So it's supposed to be calm like this. The kind of things that would really worry me are a policy mistake. If the Fed was to get into easing mode and then have to reverse, how do you price that into the forwards? How do you price in the up and down? And so I think a period of calm, and just if the 5 can hold for the 2 years, there's no reason why we can't get down towards 4 later this year.
You're actually anticipating 3 on the 10-year by the end of the year. Are you still looking for that?
Well, let's be a bit more modest. I reckon we'll be nearer to 3 than 5 at the end of the year, which means we just need to be below 4. And it seems to me that 3 is the right handle. Whether we can get all the way to 3% or not, maybe that's a bit aggressive. But to me, that 3% would be consistent with what the Fed says it's going to do. It says it's going to start easing, and the longer run dot is still just above 2.5. Now, some people may think that's too low, but if that's what they're saying, then the expected value for the 10-year Treasury should be nearer to 3 than 5.
As you say, we've been in a drugs and rock and roll period. Bonds haven't really been behaving as they used to. Does that revert? Do we head towards semi-retirement in our old rock and roll age?
I think we have to take a step back and realise what's caused the bond yield to go up. Now, it's tempting to think it was the latest data release, latest inflation print, but a more careful inspection would say it's more about growth surprising on the upside. Why did growth come through so strong for so long? Well, there's immigration, there's fiscal largesse, which has just continued, and there's some go-go in the stock market linked to tech stocks. Now, how sustainable are those 3? And this is without even talking about the election. It's just thinking about probabilities and scenarios. How plausible is it that all of those 3 are in place in a year's time? I'd say not very. And actually, how many people actually forecast those 3 variables? So it seems to me that the yields are high because of the real yield, and that's because of the growth, and not because of the inflation. It strikes me that we are going to see yields slide down towards a more sensible level.
Certainly didn't seem like Fed Chair Jay Powell was overly concerned, that's for sure.
Yeah.
China is another wild card here. And I know that you're interested in China. Do you see this latest sort of investor interest as being a sign perhaps that we're over the hump?
Do you know, it's a great diversification opportunity. Whether it's in equities or bonds, investors will look at any kind of product that is non-correlated or lowly correlated to start with. So, and maybe China just went too far, the sell-off in stocks. For bonds, it doesn't look like yields can go up much. And so there's something for both equity and bond investors. The thing about China that matters to me is that the rate differential is so much to the US that if you add that on to what's going on in Europe, it's another factor that goes into the Treasury story, because how far apart can these yields go? It's not sustainable. So China is exporting disinflation to everybody else, and it may have gone too far in terms of selling off at the start of this year. So a period of stability there as well, I think, is going to be quite welcome.
And then, Stephen, we've obviously had a huge amount of volatility in currencies, more than we had for a long time. So for a long time, it was kind of a head-scratcher why currencies were so calm, right? That's definitely changed.
Do you know, it's true, my colleagues were talking about how boring FX has been. And in fact, it has been not doing very much. And now we have all this action. Clearly, Japan must be drawing a line in the sand here. So we probably can't put too much focus on what's happening today because they're closed. But there could easily be some kind of intervention. But it seems to, for now, they've done the job. But the most important thing is that US rates aren't going up, because it's the rate differential and the growth differential that's the real problem for the dollar yen. So as long as the US side calms down, you can see that the Japanese authorities will have less to do.
Well, and then the problem is that it's been affecting emerging market currencies all over in recent days and weeks. Does that change any of your outlook on where might be value?
It's a very good point. It's difficult to find value in local rate markets in FX, because by the time you've done the hedge, there's nothing left. So it seems to have been much better in the EM external debt. This is dollar-denominated bonds, and you can see in this region the focus on Egypt, for example, and there's been Turkey. So emerging markets has been a better investment through the external debt. But the local rate markets are not really going to start moving in a positive direction until you can see the dollar turn and the US bond yields come down.
All right. You heard it from Stephen Major. It's been drugs and rock and roll. I don't know. I think we missed that here at Bloomberg headquarters. Stephen Major, HSBC Global Head of Fixed Income Research, joining us on set. Thank you. Up next, Apple predicting a return to growth as it plans its biggest buyback in history. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. Anglo American's US-listed shares jumped on a report that Glencore is considering a potential bid, setting up a takeover battle with BHP Group. Reuters reports that Glencore has had preliminary internal discussions that may not lead to an approach. Anglo American last week rejected a $39 billion all-stock offer from BHP. In other company news, Apple shares jumped in late trading after stronger than expected sales last quarter and predictions to return to growth in the current period. The iPhone maker also announced the largest share buyback in US history. For more, let's bring in Robert Lee, Bloomberg Intelligence senior analyst. So, Robert, how did Apple surprise the market? How was this not foreseen?
OK, well, I suppose the pattern we've seen in recent tech results is, very high expectations, and some companies, Meta in particular being a recent example, failing to meet those. The opposite actually happened with Apple. The challenges and problems in their China iPhone business are well known. There was quite a lot of pessimism going into the numbers, and I think the best way to summarize and look at the numbers they reported, they were less worse than had been feared. And also, more importantly, given the market looks ahead, the guidance they gave was a little bit better than expected. The commentary as well from Tim Cook and others around their China iPhone business sort of implies that perhaps we're reaching some stability on that front. So I think, as you've seen from the aftermarket reaction, the market so far has taken that quite well.
Absolutely. Now, Tim Cook, as you said, sounding very optimistic on China. Could this be the end of Apple's troubles in China?
Yeah, well, I would argue, though, yes, we may well see some stability come through in the next quarter or two, but there are some structural challenges there for Apple in China. The first being, obviously, the economy is slowing, so we're living in more cost-conscious times. There is a good array of choice out there, particularly from the local competitors, with Huawei being one of the most noteworthy. So Huawei phones tend to offer, really good functionality, a very attractive price. And so, again, that's a major challenge to Apple on that front. So I think the China story will likely continue to dominate things in the coming quarter, I'm afraid to say, for Tim Cook. But at least things might appear to be stabilising in the near term. We'll have to wait and see on that.
When it comes to AI, Robert, can Apple catch up, do you think?
They can, because one thing, how many large language models had you heard about, or even I heard about just over a year ago? There weren't many, and now, that there are a plethora of models out there, which tells you the technical barrier to entry is very low. Also, Apple's a company with great technological prowess, and obviously a huge amount of cash in its balance sheet at the moment, so it has the resources to do that. The question is, how are they really going to narrow the gap? I think it's more likely they will partner with someone like perhaps Google or Alphabet or maybe an OpenAI and maybe license or do some deal that way. And I think in a way there could be a little bit of a silver lining for them, because as compare and contrast with a lot of the other big internet platforms that are spending tens of billions of dollars on CapEx, well, actually Apple has foregone that. So perhaps by doing a licensing deal or some other deal with an existing platform is a more cost-effective way for them to try and narrow that gap. But again, that's a story that will evolve in the coming quarters, and we'll keep you updated.
Well, the stock down 10% since the beginning of the year, so we'll see if last night's post-market rally holds in the session. Robert Lee, Bloomberg Intelligence's senior analyst, thank you. Plenty more still ahead. Do stay with us. This is Bloomberg Middle East and Africa.
The situation is becoming more entrenched. The conflict is becoming more entrenched. We have had to rejig all our network to be much more permanently set to sail south of the Cape. Our view right now is that at minimum we will be well into the second part of the year before we can even consider restarting the network, and the possibility that by the end of the year we will still be sailing south of the Cape of Good Hope has certainly increased significantly since 3 months ago.
What would you need for those security conditions to look better, especially as I think I mentioned earlier in the program, the Houthis are actually expanding their attacks, not actually bringing them to a close. What does a safer security situation look like in the absence of just back to completely normal?
Yeah, given how dynamic the situation is, it's actually very difficult to be able to paint a picture of what are the different points or things that we would need to see. As you rightfully say, the situation in the last few months has seen more escalation than de-escalation, and that's what leads us to actually believe that this situation is going to be with us for longer rather than shorter. What the solution looks like, I mean, it's hard to see a good solution that doesn't come through a resolution of the conflict between Hamas and Israel, which is what triggered actually the situation in the Red Sea. And it's hard to see actually from the experience that we have had in the past few years that without a solution in that conflict that we would get to a military solution in the Red Sea that would guarantee safe passage for the trade. I think it's very difficult to see that.
That was the CEO of Maersk on the outlook for global container trade demand and the impact of the Red Sea conflict. Hamas says it's studying a temporary ceasefire plan with Israel in a, quote, positive spirit. This as international pressure mounts on both sides to reach a deal. The Iran-backed militant group says it plans to send a delegation to Egypt as soon as possible to continue negotiations. Israel has said it would only consider joining ceasefire talks once Hamas responds to the latest proposal for a temporary truce and release of hostages. Turkey, meanwhile, is halting all trade with Israel over what it calls the worsening humanitarian tragedy in Palestine. Israel's imports from Turkey reached $4.6 billion last year and include machinery, fuel, fresh produce and food. Well, let's dig a little deeper now into the Israel-Hamas war. More than 6 months in, efforts to come to a truce ongoing. The recent clash between Israel and Iran ramped up the risk of wider conflict. And while that has eased, if it ever came to pass, the global economy could lose $1 trillion. That's according to new research from Bloomberg Intelligence and Bloomberg Economics. Let's get into it a little bit more now. For analysis, we're joined by Sally Yilmaz, Senior Energy Analyst at Bloomberg Intelligence. So, Sally, what are the 4 main scenarios for the Middle East conflict that you came to in your report?
Sure. So firstly, this was a very close collaboration with our colleagues at Bloomberg Economics, especially Ziad Daoud here in Dubai. And what we have in this report are secondary effects of the conflict, which are, again, of course, not top of mind and secondary to the human cost that we've already seen. But we have 2 escalatory and 2 non-escalatory scenarios in our report. And in the non-escalatory ones, we have the confined war, which is the prevailing one where we are right now. And we haven't actually seen a big oil price impact in this one or a macro one. So from here, if we go to a potential ceasefire scenario, for that reason, we don't expect a big change, big correction in oil prices or a big impact on macro. But of course, this would reduce the human cost, which would be great for the region. In the escalatory scenarios, we could see a proxy war between Israel and Iran, and this could push oil prices towards $100 a barrel with a more meaningful impact on macro. But in the more extreme scenario of a direct war between Israel and Iran, this is where we have the increased risk of direct attacks on energy facilities and potential closure of Strait of Hormuz. And this is when we have potentially oil prices at as high as $150 a barrel. And this, according to the Bloomberg economics model, could actually cost the global GDP about $1 trillion, which would tip the world economy into recession.
That would absolutely be the worst case scenario. What about OPEC plus scenarios, though, in each of these cases?
So I think what OPEC Plus must be focusing on right now is market fundamentals. And as I mentioned, in the confined war scenario, we haven't really seen any supply disruption. So they're looking at supply. They're also looking at demand. And most of the price support that we've seen this year seems to have been mostly demand-driven rather than supply. But of course, important to note is that they are sitting on a good chunk of spare capacity. So if they had to, they haven't had to so far, but if they had to, they have the room to bring more barrels into the market.
If they had to. What sectors are most impacted in your scenarios?
So in the non-escalatory ones, even in the confined war scenario that we've been in, we've already seen shipping, as you've heard Maersk talk about as well. A lot of the Asian vessel owners have been impacted. Freight rates went up, and they've actually benefited from that. And also, even in this scenario, we've had refining margins benefit, especially the ones in Europe, especially the ones in the Mediterranean. If the war were to escalate, of course, then we would have much bigger impact on oil and gas. And of course, then oil and gas companies would benefit from this as long as their production is not disrupted.
Sally, thank you so much. Sally Yilmaz, our senior energy analyst at Bloomberg Intelligence. I do want to break some news now. Societe Generale is out with earnings, and we have first quarter net income of 680 million euros. That is a beat. The estimate was for 556 million euros. Once again, net income beating at SocGen by a nice margin, 680 million euros versus the estimate for 556. Net banking income 6.65. That was a beat. Net income overall, as I said, was a beat. FIC sales and trading revenue was a slight miss. It came in at 733 million euros. The estimate was for 735.1. And then the CET ratio, 13.2%. That was a bit better than the 13% forecast. So a beat there from SocGen. Well, that is it for Daybreak Middle East and Africa. I'm Bonnie Quinn in Dubai. This is my last show. But next week we launch Horizons Middle East and Africa with new anchor Jumana Bersecci. So do tune in for that from Monday, 8 a.m. Dubai time. Stay with us, though, for a special edition of Africa Amplified with Jennifer Zapazaja. She'll be looking ahead to this month's pivotal election in South Africa that's coming right up. This is Bloomberg.